Welcome, everyone. We're glad you could join us for today's Thought Center webcast. These webcasts are a series of live interactive events featuring EY's thought leaders. And this is the latest in our series of webcasts on the OECD final reports on the Base Erosion and Profit Shifting Project. My name is Barbara Angus, and I'll be your moderator. Today is actually the sixth in our series of 8 webcasts on the BEPS project outcomes. You can register for the remaining webcasts in the series at www.ey.com/webcasts, and you also can watch replays of the earlier webcasts at that same place. Today our focus is on 4 of the BEPS actions that all have a particular anti-abuse flavor. Action 3 on controlled foreign company rules, Action 5 on harmful tax practices, Action 6 on treaty abuse, and Action 12 on mandatory disclosure rules. These actions also all touch on the 3 core themes of BEPS, which are coherence, substance, and transparency. Today we'll talk about what the OECD is recommending with respect to each of these actions, and we'll see what countries are doing already. Before turning to our topic, we have a little webcast housekeep to take care of. I want to let you know that we will take questions throughout today's session. Using the red Q&A icon at the bottom of this interface, you have the ability on your desktop to send your comments and questions to us. We'll try to get to as many of those questions as we can during our time today. Second, there'll be polling questions that appear throughout this webcast. You'll need to respond to them in order to qualify for CPE or CE credit. So if education credits are important to you, just keep an eye on your screen for the polls during the course of the webcast. Next, you can download a copy of the slides for today's program. To do that, just click on the green folder icon at the bottom of the interface. So back to our topic. We have a terrific global panel for the discussion today. Joining me are Helmar Klink, who is an international tax services professional based in the Netherlands, Sean Lucy, who is an international tax services professional based in the United Kingdom and leading our foreign desk network there. And finally, Klaus von Bracke, who is an international tax services professional based in Germany with a particular focus on EU tax matters. We'll start our discussion today with the recommendations under BEPS Action 5 on harmful tax practices. This is actually a part of the BEPS action plan that has roots that date back almost 20 years to the work that the OECD began in the late 90s on so-called harmful tax competition. Like that earlier OECD project, the current work on Action 5 has focused in 2 areas: the treatment of special tax regimes that may be considered to cause harm to other jurisdictions, and the sharing of information between governments. The work in each of these areas has evolved quite a bit in this current incarnation. Before we turn to the specifics, it's important to note that Action 5 is one of 4 areas in the BEPS project where the final recommendations are in the form of an agreed minimum standard. So in these areas, the participating countries have agreed to take action, reflecting the view that this is an area where failure of one country to take action could have adverse consequences for other countries. With that in mind, let me turn to Klaus for an overview of the 2 focus areas of the OECD final report on Action 5. Klaus?
Yeah, thank you, Barbara. Well, actually, the OECD's final report on Action 5 unwinds 2 main areas, as was stated before. First, the definition of a substantial activity criterion to be applied when determining whether tax regimes are harmful, and, very notably, to improve transparency. Well, it can be said without exaggeration that Action 5 covers one of the core topics within the true sense of the BEPS project, in trying to realign taxation with substance requirements on the one hand, and the correlating issue on the other hand about enhancing transparency of preferential regimes. Action 5 is indeed looking on the one hand at emphasizing an additional factor in the criteria for what constitutes a preferential tax regime, the substantial activity requirement. Moreover, to tackle one of the core criticisms around preferential tax regimes, the lack of transparency, Action 5, on the other hand, also stipulates the requirement to exchange information on these regimes. It, therefore, comes not as a surprise and underlines the interest of the countries involved to solve this perceived BEPS concern, that this action is one of the minimum standards all countries could agree upon.
So let's dig a little deeper on this issue of requiring substance with respect to a regime that might otherwise be considered to be harmful. Klaus, can you walk us through the modified nexus approach with respect to IP regimes, and also how that approach might be extended to other types of regimes?
Yeah, certainly. First, as a little bit of a background, you just said it, the OECD started work already in addressing harmful tax competition in the late 90s, resulting in the 1998 report. It also created the famous Forum on Harmful Tax Practices to take this work forward. Now, in Action 5, the OECD built on these conclusions of the 98 report. It expanded the role of the Forum by committing the Forum to, quote-unquote, revamp the work on harmful tax practices. The Forum was asked to focus particularly on defining substantial activity as a requirement for any preferential regime and improving transparency, including the compulsory spontaneous exchange of rulings related to these preferential regimes. Finally, and quite important, the Forum was asked to evaluate already on existing preferential tax regimes in this BEPS context. Now, compared to already existing criteria like transparency, ring fencing, and low or no tax, the substantial activity criterion was therefore elevated to a higher level and now is one of the key criteria. An important development here is certainly the compromise being reached between Germany and UK in the late November 2014 on what's called the modified nexus approach. Considering this compromise, there's a strong potential that at least for Action 5 there can be expected a relative consistent implementation of this minimum standard requirement of both the OECD member countries and the European Union as such. Well, as said, Action 5 elevates the substantial activity requirement in importance. It is therefore critically important how substantial activity is defined. The substantial activity requirement applies to all preferential regimes in the scope. However, in the first instance, the Forum focused on defining the concept of substantial activity in the context of intellectual property regimes. Regimes providing preferential tax treatment for income arising from qualifying intellectual property.
So Klaus, how exactly does the modified nexus approach work? What does the test look at? What does it look like? Certainly from a U.S. perspective, it's not really exactly like nexus in a U.S. state context.
No, indeed, Barbara, not exactly. Now, first, under the agreed nexus approach, benefits would only be granted in respect of income arising from IP where the actual R&D activity was undertaken by the taxpayer itself. So according to the OECD, and I quote, expenditures act as a proxy for substantial activities. Capital contributions or expenditures for substantial R&D activity by parties other than the taxpayers are therefore not qualifying IP expenditures, except where such activities are undertaken by unrelated parties, and that irrespective of their residence. On the other hand, expenditures for activities undertaken by related parties would hence not count as qualifying expenditures. Now, it's quite obvious the rationale behind this approach is that the OECD Forum considered it unlikely that a company will outsource the fundamental value-creating activities to an unrelated party, regardless of where that unrelated party is located. Now, more in concrete, for patent boxes, it basically means, now translated, that there should be a nexus between the income from intangibles and the activity in this country. As a result, development work can only be outsourced to a group entity to a limited extent under the new rules. Most likely, the European Union will adopt this approach, I mentioned it before, according to this compromise paper, in their evaluation of European patent boxes. Now, taxpayers that want to benefit from this IP regime will have to track expenditures in order to be able to substantiate the prescribed nexus between expenditures and income and to provide evidence of this link to tax administrations. Now, in principle, this would be a link between expenditures, IP assets, and IP income, and taxpayers would have to track to IP assets. The final report contains a list of mandatory documentation requirements in that regard, including, but not limited to, information on how the expenditure was tracked. Based on the new substantial activity requirement, a number of regimes in the OECD and associate countries were also reviewed. The result of that review is included in the final report. Now, it's fair to say that because of this review, general countries with patent boxes will have to change their domestic laws. There is a grandfathering period, though, for taxpayers already making use of a patent box regime as of the 30th June 2016, which would grandfather the application for existing IP until June 2021. In more particular, European countries are expected to change their law because they have committed themselves either within the OECD and because the EU as such, through the Code of Conduct Group, will force them. A different matter, and not yet fully examined, is the issue whether the modified nexus approach violates the fundamental freedoms of the European Union Treaty in taking into account only expenses that have a kind of territorial relationship to the income. Now, in more general terms, the OECD also looked at informal capital regimes and excess profit regimes, such as those applied for example, in Belgium and the Netherlands. In the future, it is expected that the substantiality requirement will be applied to other preferential regimes as well, like headquarter regimes, distribution or service centers, financing or leasing, shipping, and holding regimes. But that is future work.
Klaus, you mentioned the EU a couple of times, and the EU certainly seems to be a particularly important force with respect to this Action 5. How do the OECD developments fit in with the perspectives and the activity that's happening in the EU?
Yeah, that's indeed an interesting question. I already mentioned, but did not explain, the European Union's Code of Conduct Group for Business Taxation. Now, this group plays an important role in that regard. This group was already established at an ECOFIN meeting, that's the finance ministers assemble within the European Union, in December 1997, with the clear aim of limiting harmful or unfair tax measures and practices. Now, this code of conduct is not legally binding. Nevertheless, it has exerted quite a lot of political influence within the European Union and the member states. The work of the group has focused mainly on anti-abuse rules, transparency and exchange of information in the area of transfer pricing, administrative practices, and the promotion of the principles of the Code of Conduct in non-EU countries as well. So the Code of Conduct requires member states to refrain from introducing any new harmful tax measures and also to amend any laws or practices that are deemed to be harmful in respect of the principles of the Code. The group at that time identified 66 harmful tax practices, which were all abolished or phased out. So despite that there was not a legal binding of this code of conduct, the political peer pressure was quite high. Now, it is planned to strengthen the role of this group and to monitor the implementation of the modified nexus approach. So it is fair to say that the group plays the same role as the OECD Forum. Now, in addition, even some further pressure to align current IP regimes within the European Union is stemming from the European Commission's regulatory body under state aid rules. You probably have heard of that. The body has indicated that it is examining all existing IP regimes according to the standard whether a national regime grants selective advantages to companies. At this moment, we cannot foresee if the Commission really would initiate formal investigation procedures against one or several EU member states or would leave the continuing examination with the EU Code of Conduct Group.
Thank you, Klaus. before we turn our attention to the other important prong of the Action 5 work, let's pause here and talk about what countries are doing or are expected to do to bring their patent box regimes into compliance with this new minimum standard. Sean, there's been a lot of focus on the UK patent box regime, and certainly UK policymakers played a key role in the design of the modified nexus approach in reaching that agreement. Could you give us an update on what you see happening in the UK, and then provide some highlights on what's happening elsewhere as well?
Sure, Barbara. I mean, the Klaus gave a very good overview of the direction of travel. I mean, the UK published a consultation document on the proposed changes to the UK regime just over a couple of weeks ago, and this is ahead of the publication of draft legislation on the 9th of December this year. The document explains that the UK intends to adopt all of the OECD's recommendations with respect to the modified nexus approach. And to do this, the UK intends to amend rather than replace its current IP regime, and to just make changes which are necessary to comply with Action 5. So these changes will be legislated in next year's finance bill, but will take effect from 1 July 2016. And I think Klaus mentioned the grandfathering period. That this is just going to be aligned with the OECD report. The consultation itself addresses some of the practical issues arising from the implementation of the modified nexus approach. For example, the level of granularity which companies will need to track and trace expenditure and income, and when they'll need to start doing that. And also ways of dealing with circumstances where IP is acquired as part of a business transfer. It also makes proposals as to how qualifying R&D will be measured, and companies have until the 4th of December to provide input on the proposals, and then I guess 5 days or so before the legislation is finalised. Outside of the UK, we see that the Swiss are saying that a Nexus-compliant patent box will be a feature of their upcoming corporate tax reform. The Irish recently released legislation for a knowledge development box, which is going to be introduced from 1 January next year. This, I believe, is also going to be Nexus-compliant. And the Italians are also bringing in an IP regime. So that's all on that, Barbara.
Thanks very much, Sean. I think it's fair to say that the activity and perspectives in Europe are both in contrast and in some ways in parallel to the discussions of an innovation box that began here in the U.S. this summer. In August, we saw a congressional proposal for a U.S. innovation box. The idea there is to include a version of an innovation box for the U.S. in a broader tax reform package, either international tax reform package or perhaps a comprehensive tax reform package. The view that's been expressed by many lawmakers in the U.S. is that the BEPS project, and in particular its new nexus and substance requirements, will mean that U.S. multinationals may move more activity outside the U.S. Together with the associated jobs. The need to counter that pressure from the BEPS project or the BEPS recommendations in order to keep activity and jobs in the U.S. Has been cited as another reason, among many, why international tax reform and an innovation box in particular should be considered as a matter of urgency in the U.S. That said, despite that sense of urgency, I think it's fair to say that the odds for enactment of a big international tax reform package yet this year are low. They're not zero, but I think at this point in mid-November they're low. So we'll be looking a bit farther forward. So maybe with that, let's focus on the transparency prong of the Action 5 recommendation. This is an area where we actually saw quite significant expansion of the activity during the course of the BEPS project. Klaus, let's go back to you.
Sure, and yeah, indeed. After having defined the substantial activity criterion and the other criterion for labeling the regime or a potential regime as harmful, let's first of all discuss what the various consequences are connecting with this labeling. Now, the relevant country is giving the opportunity to abolish the regime or remove the features that create the harmful effects. Other countries may take defensive measures to counter the effects of the harmful regime. But what we think is the most important issue here, and Barbara, you mentioned it, and that it's being brought forward really by the Action 5 quite well, is that the rulings on potential harmful regimes now would have to be spontaneously exchanged with foreign tax authorities. So this requirement would apply whether or not the regime is found to be actually harmful. Now, as said, since the lack of transparency is also one of the factors in considering whether a regime is harmful or not, the OECD Forum was especially asked to look into this compulsory spontaneous exchange of information on rulings issue. Now, this examination resulted in the definition of 6 categories of rulings which are now covered by the exchange of information requirement. There are the rulings on preferential regimes, the unilateral advanced pricing agreements or other cross-border unilateral rulings in respect of transfer pricing, then the bulk of cross-border rulings providing for an unilateral downward adjustment of taxable profits that is not directly reflected in the taxpayer's financial or commercial accounts. Here, the final report gives the example of excess profit rulings, the info-cap and similar rulings that recognize the contribution of capital or an asset and provide for an adjustment that reduces the taxable profits, such as through a deemed interest deduction on an interest-free loan, for example. Then next, the PE rulings as such, related party conduit rulings, and in addition, information exchange would also apply to any other type of ruling agreed by the OECD Forum that in the absence of spontaneous exchange of information gives rise to BEPS concerns. This last category gives the Forum also the flexibility to extend the obligation to exchange information to additional categories of rulings in the future. Now, the information exchange requirement would not relate to the ruling itself. I think that is quite important to note, but to certain information as contained in the template included in the final report. The tax authorities of the receiving country could then determine that to request the ruling itself, which would then be exchanged in a second step. Information would have to be exchanged with any affected country. Which countries are considered as affected varies depending on the category of ruling concerned, but includes in all cases the residence country of the ultimate parent company and the immediate parent company. In most cases, information also will have to be exchanged with the countries of residence of related parties with which the taxpayer enters into a transaction that is covered by the ruling. The framework also deals with questions of confidentiality. Now, as concerns the timeline, the OECD agreed on the following approach. First, information on rulings issued on or after the 1st of April 2016 will be exchanged at the latest within 3 months after the ruling has become available to the competent authority of the country granting the ruling. Second, the obligation to exchange information also applies to rulings that were issued on or after 1st January 2010, so going back, and were still in effect as of 1st January 2014. The process to exchange information on these rulings is to be completed by the end of 2016. The OECD Forum will monitor and review compliance with the obligation to spontaneously exchange information under Action 5. So this is one of the requirements being agreed within the minimum standards. This will involve an annual review by the Forum starting at the beginning of 2017 To that end, countries that provide taxpayer-specific rulings that fall within the framework will be expected to provide certain statistical information on an annual basis. Back to you, Barbara.
Thanks, Klaus. In addition to this OECD work on rulings, there is a parallel project in the EU for exchange of information with respect to rulings. While those rules in the EU are similar, they're not identical to the OECD rules, and I think it's important to look at both of them together. So, can you just walk us through how the EU is addressing rulings?
Yes, certainly. There's an additional layer of complexity here, and I hope we do not get mixed up with these things in particular if we go later on into also the timing issues. So indeed, a day after the OECD published the BEPS final reports, the EU finance ministers Council adopted a similar measure on transparency, also with retroactive effect, and going even 5 years back. Now, you said it, although the scope is somewhat narrower. Now, first, it is important to note that the finance ministers at the moment only reached a political agreement. We are still waiting for the final legal agreement to come later this year, obviously. This directive, in the jargon of European law, aims at increasing transparency in relation to the assurances that member states give to foreign companies about how their taxes will be calculated. The directive takes the form of new requirements to be included in the already existing legislative framework for information exchange via amendments to the Directive on Administrative Cooperation. The mechanics of this exchange are similar to the Action 5 requirement. First, under the directive, member states will be required to exchange information, not the ruling itself, information automatically on advanced cross-border tax rulings, as well as APAs, and both are defined in the directive. Member states receiving the information will be able to request further information where appropriate. The European Commission will develop alongside that a secure central directory where the information exchanged would be stored. The directory will be accessible to all member states and, to the extent that it is required for monitoring the correct implementation of the directive, also to the Commission. But that's important to note that the Commission does not get access to the information itself nor to the rulings. They do only have some kind of safeguard functions there. The directive also considers confidentiality issues, such as safeguarding the protection of taxpayers' personal data, as well as the protection of interests. But it is fair to say that the Commission will play a similar role as the OECD Forum in that regard. Now, also, as said, coming back to the application of the new rules, the new rules will have to be applied beginning from 1st January 2017. However, concerning, as said, rulings issued before January 1st, 2017, there are specific transition rules which will apply, and that's the 5-year retroactive period. And there we have to differentiate. If advanced cross-border rulings and APAs are issued, amended or renewed between 1st January 2012, so 5 years going back, and the 31st December 2013, information exchange will be required only if the ruling is still valid on the 1st January of 2014. If advanced cross-border rulings and APAs are issued, amended and renewed between January 1st, 2014 and 31st of December 2016, information exchange will be required irrespective of whether they are still valid or not. So it's quite a strict rule here. So back to you, Barbara.
All right. Thank you very much, Klaus. Elmar, I think it's time to bring you into the discussion. Can you give us an update on the activity that's happening already in some countries around the world in this area? And I think maybe a good focus here is what you expect to see in the Netherlands.
Yeah, of course. Well, this is obviously quite important to the Netherlands. And most Dutch multinationals have what we call horizontal monitoring rules concluded with the Dutch tax authorities. That means that rather than having extensive audits every so many years, multinationals are part of an ongoing disclosure and review process. In return, they are able to obtain quick responses from the tax authorities on any uncertainties that may arise in their day-to-day practice. And foreign multinationals may, of course, also apply for an advance ruling in order to agree upfront on the applicability of the participation exemption, finance margin, transfer pricing, and other questions. Now, on October 5 of this year, actually quite recently, the Dutch State Secretary of Finance sent a letter to Parliament outlining the Dutch government's view on the reports issued by the OECD in respect of its BEPS project. And in 2016, the Netherlands will already start to exchange information regarding rulings exactly in line with the BEPS Action 5 standards. Furthermore, quite interestingly, this summer, the Dutch and German Ministers of Finance signed a memorandum of understanding on the exchange of information with respect to rulings. Now, that was the first time ever, as far as I know. We've now seen the format of the exchange, and we do think this is a well-balanced approach. Transparency has always been an important feature of the Dutch ruling policy. With respect to other countries, we haven't seen too much response yet, and I think as these transparency developments unfold, it's important not to forget the important role rulings can play in providing certainty to taxpayers.
Thanks, Helmar. And while you're talking about the Netherlands, we've actually gotten a question that first part of Action 5 and patent boxes, and the person with the question wondered what the Netherlands is likely to do with respect to their patent box. Presumably, that's also something that's important for them to protect. Some comments there?
Yeah, well, obviously this is very important for the Dutch regime, and obviously we will be in compliance with the new rules. But for us, the key point is that it has to go about patentable technology. So that's a key differentiator with some of the other countries. Other than that, I think the Netherlands sort of subscribes what has been agreed. Already in the current Dutch regime, it's very important that the IP activities are really managed and controlled from the Netherlands. Otherwise, you simply don't qualify for the regime.
So a form of nexus is an existing feature.
Exactly. Yeah.
All right. Thanks very much, Helmar. So, in addition to the interaction with the EU rulings transparency initiative, this second prong of Action 5 also has significant interaction with the OECD recommendations under Action 13 on transfer pricing documentation. So in the new tiered framework involving both a master file and a local file, there are aspects of information with respect to rulings that will be required in each of those tiers. In the master file, companies are required to include any unilateral APAs they have. Then when you turn to the local file, companies are required to provide copies of APAs and other tax rulings related to controlled transactions, where the local tax authority is not itself a party to the rulings. So this really, I think, reinforces just how intertwined all of the actions and the related recommendations are. With respect to rulings, a key focus for both the ban and separate parallel developments in the European Union, and putting all of those pieces together is something I think that's important to do. Before we move on to our next action, one last question for you, Klaus. Harmful tax practices has always been an area where the OECD has intended to export its work to non-OECD, non-G20 countries. So can you tell us a bit about the OECD's plans in this regard, about outreach with respect to this action?
Yeah, sure. As said, first of all, this Action 5 is being set as a minimum standard. So in addition to monitoring the application of the framework for spontaneous exchange of information and rulings, the OECD Forum will also continue to monitor the preferential regimes, that's for sure. With respect to preferential IP regimes, monitoring will specifically cover the legislative processes undertaken by countries to update IP regimes that do not meet the nexus approach. The application of the nexus ratio as rebuttable presumption if countries decide to apply this option, as well as the granting of IP regime benefits to other IP assets. Now, coming back to your question, to ensure a level playing field and to avoid the risk of harmful tax practices being now simply displaced to third countries, the Forum will engage heavily now with other non-OECD member countries on the basis of the framework developed in the final report. And if my recollection is correct, then the OECD already started with an Asian conference last week in bringing exactly one of these issues to a broader attention. So that is all I can say for the moment. Back to you, Barbara.
Great, thanks very much. So there really is a lot to Action 5, and as we noted at the beginning, the changes here are agreed minimum standards. So we can expect to see activity related to countries' commitments in this area. We're seeing it already, and should see increasing activity in the coming months. So definitely a space to watch. But on this webcast, I think we need to move on to our next action, and to look now at another of the OECD's agreed minimum standards, the work on Action 6 on addressing treaty abuse. In many ways, this is very traditional work for the OECD because it involves the development of rules that will protect the allotment of benefits under tax treaties. So anti-abuse provisions that will be incorporated into the OECD's model tax treaty to ensure that benefits go to those who are the intended beneficiaries. Helmar, what's your reaction to the Action 6 final report?
Yeah, thank you, Barbara. Well, to be honest, I'm a bit disappointed. Treaty abuse is described as one of the most important sources of BEPS concerns, but despite earlier promises, there's actually not much news in the final report. Many important decisions have been postponed. For instance, further work is required with respect to the limitation on benefits provision, or LOB provision, as we call it. And the same applies to access to treaty benefits by funds other than collective investment vehicles. But both are important matters. But let me try to give you a quick summary, which is not easy. So the report consists of three parts: Section A, B, and C. Section A is probably the most important part and includes a minimum anti-abuse standard for treaty shopping, as well as certain targeted rules to be included in tax treaties that would address other forms of treaty abuse, such as situations of dual resident entities and rules that apply to a permanent establishment situated in a third state. Then Section B contains revisions to the title and preamble of the OECD Model Tax Convention to clarify that the intention is to eliminate double taxation without creating opportunities for non-taxation or reduced taxation through tax evasion and avoidance, including through treaty shopping arrangements. And then finally, Section C gives tax policy considerations relevant to the decision to enter into a tax treaty with another country. Countries have committed to ensuring a minimum level of protection against treaty shopping. Like I said, Section A of this report is the most important part. It specifies that countries should include one of the following three provisions in their tax treaties. First choice, a combined approach consisting of an LOB rule and a principal purpose test, and what we call the PPT rule. Then the second one is a PPT rule alone, basically the UK approach. Or third, an LOB rule supplemented by specific rules targeting conduit financing arrangements. Countries can choose among these three options, but this is the minimum standard to combat treaty abuse. Earlier this year, there was actually a lot of discussion on the application of these rules to collective investment vehicles, or SIVs and non-SIVs. Now, that's important to many of our clients. So with respect to SIVs, the report concludes to follow the 2010 OECD report in this area, but it leaves it up to the treaty partners how to put that into practice. Now, that is, however, still better than the situation for non-SIVs, such as various types of private equity funds and pension funds. The final report does not contain any model provisions or related commentary in respect of the treaty entitlement of these funds, and it simply notes that further work is needed in this area. They do note that the OECD recognized the economic importance of non-SIF funds and the need to grant treaty benefits where appropriate. They are, however, concerned that non-treaty protected investors would also benefit from treaty protection. And they're also concerned, I think, about the possibilities to achieve deferral benefits. Actually, they do make a comment on that. Now, I also should make a special comment on pension funds, as I was quite surprised by the lack of progress. The OECD's final report states that we will have to wait until 2016 for a definition of a recognized pension fund.
Thanks, Elmar. So there really is a good bit of work left to do with respect to Action 6. I appreciate the introduction to what is a big and complicated topic. The principal purpose test and the limitation on benefits provision are really very different approaches to addressing treaty shopping. And as you note, their first, and I think from an OECD perspective, their preferred option is the combined approach. But it is kind of hard to imagine how they would work together in a combined approach. But so perhaps best to talk about them one by one, and let's start by talking about the PPT. Rules like this are included in quite a few treaties already, but query whether how these rules are approached going forward will be a departure from prior practice where they've been in place. Elmar, what guidance does the OECD final report give us on this new version of a PPT?
Yeah, Barbara, you raise a very important point. So the proposed rule stipulates that, and I quote, "A benefit under this convention shall not be granted in respect of an item of income or capital if it is reasonable to conclude, having regard to all relevant facts and circumstances, that obtaining that benefit was one of the principal purposes of any arrangement or transaction that resulted directly or indirectly in that benefit, unless it is established that granting that benefit in these circumstances would be in accordance with the object and purpose of the relevant provision of this convention." Now, if you read that for the first time, you might think that it is, in fact, not very different from the guiding principle in the current commentary to the OECD Model Treaty. But you're absolutely right, Barbara. I'm afraid that the interpretation going forward will be very different from how this provision was interpreted until now. First of all, we're talking about, quote, "one of the principal purposes." And as they explain, and I quote again, "Obtaining the benefit under a tax convention need not be the sole or dominant purpose of a particular arrangement or transaction. It is sufficient that at least one of the principal purposes was to obtain the benefit." End of quote. So in other words, if there are legitimate commercial reasons for a transaction, but obtaining treaty benefits is also perceived to be a reason for the transaction, then the treaty benefit will be denied on the basis of the PPT test. When you wonder how we should distinguish between various purposes, like a main purpose, principal, ancillary purpose, subordinated purpose, guidance is lacking. I'm afraid this will create significant uncertainty. And I'm also afraid that the examples will not be sufficient to provide the clarity we need. Most examples are quite obviously right or blatantly wrong, so that the outcome would not seem to be in doubt. In other words, they miss the opportunity to provide useful guidance in the more foggy part of the spectrum. Another concern that I have is the burden of proof. Tax authorities do not have to establish that obtaining a treaty benefit was one of the principal motives. It is sufficient to fill the PPT test if, and again I quote, "it is reasonable to conclude." So that's a very light test. So they only have to conclude it's reasonable to conclude that treaty motives were present. Now, so I think we may conclude that the burden of proof has now decidedly shifted toward the taxpayer.
Interesting points, Elmar, and I think several concerns about how the PPT will work in practice, which is probably a good time to turn to Sean, since the PPT is often referred to as the UK approach. So what do you see the UK policymakers doing with respect to the recommendations for addressing treaty shopping, Action 6?
Yes, thanks, Barbara. Thanks, Helma. I mean, the comments that Helma makes are very much ones which UK tax professionals have had to deal with that uncertainty for a long time, because the UK has a long history of having PPTs or variants of what Helma describes in its domestic tax legislation, and hence it now being referred to as the UK approach, hopefully not derogatorily. We understand that HM Treasury like it as an approach to tackling abuse where it occurs, and at the same time providing flexibility to ensure that the appropriate treatment in circumstances where treaty shopping is not employed is applied. And the UK tends to view that an LOB provision, although perhaps clearer and easier to self-assess, doesn't give quite the same flexibility, and in certain circumstances won't provide double relief where it should do so. So we expect the UK to introduce PPTs into its double taxation treaties, either renegotiated or through Action 15 and the multilateral instrument, which we aren't really talking about today. And I understand that's largely the view mirrored across the EU. I mean, I think it's probably also worth saying, Barbara, that they're based on our experience from other areas of UK tax legislation where similar PPT type rules apply. There's typically two stages to the analysis. The first is to clarify whether a tax advantage actually exists when compared to what the business may otherwise have done. Normally that's established by considering the most suitable alternative transactions and evaluating whether a benefit arises in that transaction in question, which I suppose is something we've got used to doing in the UK since the introduction of the intellectual property legislation, but may feel a little bit difficult to understand for others. And also, is that same tax advantage that the purpose or one of the main purposes of the transaction, normally considered with a view to all the relevant commercial, legal and regulatory reasons for undertaking the transaction. However, there's still clearly a large grey area there. And I suppose we see this as generally being a useful approach for interpreting this type of provision. But in practice, I mean, the whole subject to treaty shopping and the impact actually on the UK may be slightly out of kilter with some of the other European territories, because withholding tax isn't something that we see that often in the UK, because we have no dividend withholding tax. It's an exemption. It just doesn't exist. And the domestic withholding tax on an interest, although technically it is levied, there are a number of statutory ways or exemptions for dealing with that within the domestic legislation. So I doubt we'll see any UK domestic withholding tax change on interest, dividends or royalties as a result of Action 6.
That's interesting, Sean. And Klaus, maybe a good time here to think about other countries, and in particular the EU dimension. Is there sort of an EU analog to the Action 6 focus?
Yeah. Actually, Barbara, this is quite interesting. That's quite independent from the BEPS initiative. The EU member states, or in particular the European Union, could already state, well, we've done already our homework. There's no much further work, at least in some regard, and that refers to the Parent Subsidy Directive, where the EU member states already recently agreed on amending the Parent Subsidy Directive and to introduce a kind of general anti-abuse rule, which implies the principal purpose test. So this jar in the Parent Subsidy Directive provides, as said, for a PPT as a general standard in European tax law. So member states are now required to implement this PPT if they hadn't had it before in their national law. Now by way of implementing the amendments to the Parent Subsidy Directive. and member states are required to do so already now by 31st of December this year, 2015. So the JAR will come into effect January 1st, 2016. So in that regard, it came quite handy that the European Union already could show, hey, look, we've just done already our homework in that respect. And further, it already announced that in its action plan of this year in June to tackle this kind of aggressive tax planning by way of also extending the interest and royalty directive by bringing in a similar type of PPT rule. And making that required to implement with the EU member states, but that is still under discussion, so we do not have any proposal yet.
All right. So another area where we've got to watch not just the OECD and individual countries, but also the collective of the EU. So Helmer, I think it's time to get back to you. In contrast to the PPT. We definitely need to discuss the LOB provision, which is included as an alternative or as a combination. Those rules are complicated, but we're going to look to you to give us an overview of the approach taken in the final report.
Well, it's good that you prepare me, Barbara, because an overview of that is a challenge. The rules are very detailed and complex, and they're not yet final. So the final report contains model treaty provisions for an elaborate LOB rule and for an alternative simplified LOB rule. The simplified LOB rule sets forth general standards that could be used to address the most obvious cases of treaty shopping, while relying on the PPT rule to cover cases not caught by that LOB rule. Then the report clarifies that the simplified LOB rule is only intended to be used if the countries agree to incorporate the combined approach of an LOB rule and a principal purpose test. Then paragraphs 1 through 6 of this new Article 10, called Entitlement to Benefits, sets forth the model treaty provisions for the LOB rule. And in general, these provisions consist of a series of objective tests that would determine whether a person is considered to be qualified and therefore eligible for treaty benefits. The objective tests are based on characteristics such as legal structure, ownership, or activities, always ensuring a link between the person and the resident state. The report notes that while it has been decided that such a rule will be included in the OECD model, further work on the LOB rule is necessary. The final report references to the proposals by the United States to modify the LOB rule in the US Model Treaty. In other words, the current LOB rule, in its commentary in the final report, should be considered as draft and is subject to change pending further review that will take into account the finalization of the LOB rule in the US Model Treaty. So final versions of the LOB rule and commentary are expected to be completed in the first part of 2016. I don't know how we're doing on time, but if you allow me, I can make a few quick comments on some of the more important provisions. So if I can start with the EU exception. So the revised discussion draft reflected a general concern raised by the European Union that some of the tests of the LOB rule might need to be adapted to reflect EU law requirements. Now, an executive decision has now been made that countries may address these concerns by including alternative arrangements. Then there's the important derivative benefits provision. That unfortunately is still bracketed, meaning that it's still not final. And the same applies to the indirect ownership requirement, which requires each intermediate owner to be a resident of either contracting state. So we still don't know where that's going to end. Then there's the discretionary relief provision. And originally it was proposed that at its discretion, a competent authority would be able to grant treaty relief to a resident when such person otherwise would be denied treaty benefits under the objective test of the LOB rule. Now, the proposed commentary contained a general assertion that in order to request discretionary relief under this rule, a clear identification of reasons unrelated to obtaining benefits under the treaty should be established. The revised discussion draft proposed additional guidance concerning the relevant factors that should be taken into account by a competent authority in considering a request for discretionary relief. And the final report just incorporates these recommendations without any modification, unfortunately. So, for example, in the case of a subsidiary with a parent in a third country, the report states that, and I quote, while the fact that the relevant withholding rate provided in the treaty is not lower than the corresponding withholding rate in the tax treaty between the country of source and the third country would be a relevant factor, that fact would not in itself be sufficient to establish that the conditions for granting the discretionary relief are met. So if countries start implementing this interpretation, companies will simply have to start factoring in higher withholding tax rates, I'm afraid.
So certainly something to focus on, both the LOB and the PPT. So as a quick aside on the LOB, issues have long been raised about whether the approach that's reflected in the limitation on benefits rules is compatible with EU law. Klaus, what are your thoughts on that question?
Well, talking about time, do we have hours left? So then I can give you this lifetime challenge to explain a bit more. But a fun aside, it's indeed true that by way of implementing the original Parent-Subsidy Directive, several EU member states already implemented national anti-directive shopping provisions, as I would call them. And they very much, though, resemble the LOB clauses, but, well, they are not that sophisticated, I have to say. Now, just to quote one example, talking about Germany, which were among those member states who implemented the kind of LOB clause, they already had to amend it. So Germany already had to amend it twice in order to comply with what we call the freedom of establishment principle. So, in other words, there's a clear example that member states trespassed their way of implementing taxpayer-friendly clauses in over-exaggerating the criteria within these LOB laws.
Thanks, Klaus, and we'll have to schedule another session to get the full version of the history of the EU law, the four freedoms and limitation on benefits provisions.
I'd love to.
So just a quick note about the U.S. position here. U.S. Treasury has been clear throughout the OECD discussions that the U.S. will not use the principal purpose test. A similar type of provision was included in a couple of treaties in the U.S. in the late 1990s, and with Senate Foreign Relations Committee as part of the advice and consent responsibility. The U.S. has long insisted on the inclusion of an LOB provision in each of its treaties. I think it's fair to say it's a non-negotiable point for U.S. Treasury. And at the same time, Treasury is considering making refinements to the LOB provision in the U.S. model treaty and has put proposals out there. Helmer mentioned this earlier. There's been a lot of speculation about whether any country other than the U.S. will be interested in the LOB provision that's in the final report. Sean, are you seeing any appetite in countries to go the LOB route in light of this new focus on addressing treaty abuse?
Not ever so much, Barbara. And to my knowledge, I think most countries are looking at the PPT route. But also, I think it's inevitable that some countries will actually take an expansive approach and incorporate both the PPT and the LOB. I understand from an Indian colleague that the Indian tax authorities are considering this at the moment. And I personally believe that through a combination of domestic legislation by countries and Action 6/15, that more than maybe just a PPT or more than just an LOB will be implemented in some territories. And I think that the incentive to do that is particularly strong where territories adopt a source-based taxation and rely on withholding taxes in particular.
Thanks, Sean. Helmar, before we move on, can you give us a quick report on some of the targeted anti-abuse rules that the OECD's also included in the final report? So not just the big anti-treaty shopping provisions, but the more targeted provisions that they propose as further supplements.
Yeah, of course. So the report includes quite a few recommendations for targeted anti-abuse rules. And those rules would cover specific scenarios, such as splitting up of contracts to avoid the PE threshold, hiring out of labor cases, transactions intended to avoid dividend characterization, dividend transfer transactions, capital gains on the sale of real property, tiebreaker rules for determining the treaty residence of a dual resident entity, and triangular arrangements involving income attributable to a PE in a third country. Those are a few examples.
Thanks very much. So just a couple of final notes with respect to the treaty amendments under Action 6 to address treaty abuse. Work is already underway on the multilateral instrument under Action 15 that's intended to be used to incorporate the treaty-based recommendations, such as the anti-abuse rules of this Action 6, into bilateral treaties expeditiously. The negotiating group for the Action 15 multilateral instrument met earlier this month for its first working session. More than 90 countries participated. I think it was actually 94 countries that participated in that meeting. So interest is broad and widespread. With respect to Action 6, then, the bottom line is that the anti-treaty shopping recommendations that we've been discussing could well be part of bilateral tax treaty relationships by even relatively early in 2017. And one area that we've gotten a question about, and I think is an excellent point as we're looking ahead to some of these rules being in place in countries that haven't had them before, is all of the mechanics that will need to be dealt with in order to be able to demonstrate or prove both residence and a qualification as a qualified person or good beneficiary under either or both of these new tests. I think there will be a big challenge for tax administrators to come in order to put that infrastructure in place that will the day-to-day implementation of these new policies. So now let's switch gears and we'll focus for the rest of the webcast on two areas where the OECD final reports take the form of best practices recommendations. The first of these that we'll talk about is Action 12, disclosure of aggressive tax planning. Sean, what are the OECD's objectives in this area?
Well, Barbara, one of the challenges faced by tax authorities is a lack of timely, comprehensive and relevant information on potentially aggressive or abusive tax planning. And whilst audits remain a key source of information on that tax planning, the view is that they've not really been effective as a deterrent to such planning. And the information that the tax authorities have from those is often very long dated. So Action 12 is all about identifying domestic and international tax avoidance schemes and requiring these to be disclosed either by the company in question or the promoter, and I'll come on to explain what that means, a promoter to the relevant tax authority. So the final report provides an overview of mandatory disclosure regimes based on the experience of various countries that have those regimes. And in this respect, the final report notes that amongst the OECD and G20 countries, such disclosure rules have been introduced in the UK, the US, and also Canada, South Africa, Portugal, Ireland, Israel, and Korea. It examines the key features of these regimes and uses these as a base for its recommendations for a modular design of a mandatory disclosure regime. And comments made during the consultation included the need to focus the rules on abusive arrangements, so that those kind of aggressive tax planning, and the preference for a best practice rather than a building block approach. And it also concerned the issue of legal privilege and concerns over self-incrimination by companies. So Action 12 therefore identifies three key outputs. The first is a recommendation for the modular design of disclosure rules. A second, a focus on international tax schemes and a consideration of a wide definition of tax benefit to capture such transactions. And lastly, designing and putting in place enhanced models of information sharing for international tax schemes. And we've already heard about the ruling methods from Klaus and Helmar. And that's over and above the current EU ruling sharing, JITSIG, which is the Joint International Tax Shelter Information and Collaboration formed in 2004, and other BEPS suggestions. And this one is a new development based on the earlier draft in March this year.
You know, as you say, the OECD stresses the need in this area for countries to be able to adapt any disclosure approach to their own particular circumstances. But that said, the report includes quite specific recommendations with respect to several of the key design features. Sean, can you take that?
Sure, no problem. And I suppose it's worth saying, Barbara, that when I read Action 12, certainly the first time, parts of it were tremendously familiar to me, even though I hadn't read it before. And that's because the concept of a hallmark is introduced. And that's a concept that is effectively central to the UK's disclosure rules, which are called the UK Disclosure of Tax Avoidance Scheme Rules, and what, if I refer to them again, are referred to as the DOTAS, UK DOTAS legislation. So Action 12 of the report makes a series of recommendations about the design of mandatory disclosure regimes intended to allow maximum consistency between countries, whilst also being sensitive to local needs and in particular to compliance costs. So the report focuses in particular on international schemes, which are viewed as an area of special concern and of course the primary focus of the OECD BEPS project. It states that the disclosure schemes that are intended to address domestic avoidance, such as the UK has at present, might not be sufficient to capture cross borders, and therefore provides recommendations for an alternative approach. The report makes it clear that the mandatory disclosure recommendations are not the minimum standard, and the countries are free to choose whether or not to introduce such a regime, as you alluded to at the start of this section. Unlike some of the other actions, this one is less directive but more suggestive. So, for example, the report states that the countries will need to choose whether they place the onus for reporting primarily on the promoter, whether to implement dual obligations for both the promoter and the taxpayer. However, in the case where promoters have the primary disclosure obligation, it's recommended that this obligation revert to the taxpayer where the promoter is outside of the country or asserts legal privilege, or where the arrangement is in itself actually constructed, or the idea is developed by the taxpayer, i.e. there's no promoter. So where an arrangement is disclosed just by a promoter, the Action 12 report recommends that the promoter be required to prepare client lists and that there be a scheme reference number system. And the client lists and reference numbers are also viewed as useful tools even when taxpayers are subject to their own disclosure requirements. So Action 12 notes that these tools may not be as essential where a jurisdiction has implemented dual reporting obligation disclosure but is relevant for promoter-based one. So countries are free to choose their own definition of promoter advisor. Again, this is suggestive, and the report provides examples of definitions from existing legislation countries use. For example, a promoter might be defined as a person that's responsible for the design, marketing, organisation or management scheme, and an advisor is one who provides assistance or advice with respect to creating, developing, planning, organising or implementing a transaction. So the report includes a further note, not included in the previous discussion draft, the input from domestic stakeholders will be important in establishing the appropriate definition of promoter, and that phraseology is very kind of UK centric, as it kind of refers to a consultation process, which I mentioned earlier in the presentation, and it's something which the UK does in respect of almost all new legislation these days. In existing disclosure regimes, disclosure is often triggered by an arrangement that has certain hallmark characteristics, and the Action 12 report recommends that the existence of just one of those hallmarks in respect of a scheme should be sufficient so as to create an obligation to disclose. So hallmarks are suggested they could be either general or specific, and the report recommends that each country's hallmarks should include a mixture of both types. So a general hallmark could be, for example, a promoter's desire to keep the arrangement confidential from other promoters, or the requirement that it has a contingent or premium fee subject to agreement of the transaction with the tax authorities. It also indicates that countries may want to adopt general hallmarks, such as where there's a standardized tax product or something that's commoditized. Action 12, just to keep going, it also recommends that countries use specific hallmarks for their local circumstances. So an example of a specific hallmark would be a leasing transaction, a transaction that's included on a blacklist, those that could be using losses or schemes that convert income from one category of income to another, or transactions with counterparties in low tax jurisdictions, so all sorts of specific hallmarks. And individual countries are left to design those specific hallmarks most appropriately to their circumstances. And if they want to, they can actually attach filters to them, such as a de minimis filter in terms of size. So countries may choose which approach they want, or kind of have objective tests when they're looking at the generic or specific hallmarks. And unlike the previous discussion draft, the actual report provides examples of factors relevant to the application of confidentiality, premium fee hallmarks, those general ones I mentioned. And under a hypothetical test, the confidentiality hallmark would be met if a scheme were sufficiently new and innovative that the designer or promoter of that scheme would have required the details of the scheme to remain confidential, irrespective of the existence of the actual terms of confidentiality. And actually that is one of the general hallmarks currently within the UK tax regime. So that's probably enough for now on that, Barbara. Back to you.
Yeah, so Sean, you've mentioned a couple of times some changes from the discussion draft to the final report, and there seem to be several areas where there have been changes. I think one of the areas that attracted quite significant comment during the discussion draft process was the proposals for very broad disclosure with respect to what they referred to as international tax schemes. So where did the OECD come out in?
Yeah, that's important, especially for the BEPS, isn't it? And I think so. The Action 12 report states that cross-border transactions raise particular issues for a disclosure regime, because it may not always be clear in a certain jurisdiction whether a tax advantage has been obtained in another jurisdiction. So therefore an alternative approach is recommended for the design of a disclosure regime for international tax schemes. Okay, so Action 12 report recommends that threshold conditions such as the main benefit test shouldn't apply to a cross-border outcome. This is because the recommended hallmarks will target only arrangements of particular concern for a tax administration. So special hallmarks should be developed for cross-border outcomes, and these hallmarks should focus on BEPS-related risks proposed by cross-border arrangements, and should be broad enough to capture different and innovative planning techniques. So the hallmarks should be both specific in that they identify cross-border tax outcomes which raise concerns for that particular jurisdiction, and generic in that they're defined by reference to their overall tax effects and are capable of capturing any arrangement designed to produce those effects. So it's effectively a combination of legislation that may be introduced under the coherence steps in BEPS, such as Action 2 and Action 4, in conjunction with this Action 12 disclosure regime. And in contrast, the discussion draft so as to avoid unnecessary disclosures, it states that each tax administration should provide a specific list of tax regimes and outcomes that are not required to be disclosed. So it further indicates that as part of the future work on monitoring the outputs from the BEPS projects, countries may consider developing additional hallmarks, including model hallmarks, to minimize the overlap between disclosure regimes with respect to particular transactions. So the Action 12 report also proposes that transactions should be reportable in a specific country only in circumstances where a domestic taxpayer or their advisor could reasonably have been expected to be aware of the cross-border outcome of the arrangement. And that's in contrast to the discussion draft, which would have required disclosure where the cross-border outcome arises within the taxpayer's controlled group or where the taxpayer was a party to that agreement. In terms of other differences, the report also suggests that a domestic taxpayer or its advisor be required to disclose any material information that's within its knowledge, possession or control. So it further recommends that imposing an obligation on a domestic taxpayer at the time it enters into material intergroup transactions to make reasonable inquiries as to whether the arrangements give rise to the transaction incorporate a cross-border outcome under that hallmark, and to notify the tax administration if the group member has not provided relevant information, and the information is inadequate or incomplete, or there's an unreasonable delay in providing it. And the discussion draft didn't really go into this previously, and didn't cater for this particular obligation, which is new. So it'd be interesting to see if different states adopt that. And I think probably finally the Action 12 report includes a couple of examples in relation to intergroup hybrid mismatch arrangements, which are adapted from an example included in the final report in Action 2. Now, recommendations regarding disclosure of international tax schemes apply. So, for example, they listed two examples involving a notional interest deduction and an interest-free loan, which are not included in the Action 2 report, but would potentially be something which would need to be considered in relation to Action 12 and disclosure regimes. So over to you, Barbara.
Thanks, Sean. Maybe just another question, because you noted that there is some clear parallels with the disclosure regime in place in the UK. What has been the experience with the UK regime?
Well, I mean, it's very much my view. I mean, the UK regime came in 2004, and it's had, I'd say, a tremendous effect at closing down, in particular, domestic aggressive tax planning arrangements. Those changes didn't happen overnight, but over a number of years, gradually and successfully, HMRC increased their knowledge of such planning, and based on the disclosures at the time of implementation, closed down the loopholes. And I'd say it probably took 5 years or so, gradually, whilst that tightened the neck or the noose around that aggressive tax planning. And I think to a large extent, certainly, within different spheres, it's been eradicated. And it'd be interesting to see whether the UK authorities believe that their DOTAS rules will be sufficient in combination with or whether actually they'll need to be expanded any further. I suggest they probably won't.
Interesting. Helmar, just a quick question. Are we seeing interest in other countries yet in the OECD's recommended disclosure rules?
No, not that much. Now, there are new regimes in Brazil and Mexico, and France has also looked at it. But I understand there are constitutional concerns, so I'm not sure where that will end. In the Netherlands, we will not adopt this as it's not a required minimum standard. So other countries, I haven't heard anything.
Right. All right. Well, another space to watch. So our last topic today, which we'll cover just briefly, is another action where the OECD recommendations are in the form of best practices. That's Action 3 on strengthening controlled foreign company or CFC rules. The final report on Action 3 reflects a significant change in tone from the April discussion draft. Like the discussion draft, the final report provides recommendations with respect to what it calls building blocks of CFC rules, but the final report specifies that the recommendations are not minimum standards, but instead, and I quote here, are designed to ensure that jurisdictions that choose to implement them will have rules that effectively prevent taxpayers from shifting income into foreign subsidiaries. I think importantly, the final report also highlights the differences in countries' policy objectives, as well as the differences in prioritization of those policy objectives. It states that the recommendations are intended to provide flexibility to countries so that they can act in a manner consistent with the policy objectives of their overall tax system. So the OECD divides the policy considerations in connection with the design of CFC rules into two categories: considerations that are shared by countries and specific policy objectives that countries may prioritize differently. The shared considerations that the OECD looks at include potential deterrent effect, interaction with transfer pricing rules, so CFC rules as a backstop to transfer pricing rules, effectively preventing avoidance while reducing administrative and compliance burdens, and also avoiding double taxation. With respect to other policy objectives that may be implicated by CFC rules, the final report identifies two fundamental differences that can affect the design of these rules: whether the country has a worldwide tax system or a territorial tax system, and whether the country is a member of the EU. Two specific policies are influenced by whether the country has a worldwide system, which is the U.S. and a few other countries around the world, or a territorial tax system, which today is many countries around the world. One of those is striking a balance between taxing foreign income and maintaining competitiveness, and then preventing base stripping is the other objective that the OECD identifies here. Finally, the final report indicates that the limitations on CFC rules that there are limitations that apply within the EU, and that means that the recommendations on this action have to be adaptable where necessary in order to allow EU members to comply with those obligations. And here the OECD notes that this is countries outside the EU as well because of competitiveness considerations. So looking to what countries could do within the EU may be relevant to countries outside the EU who want to have a level playing field. The report goes out of its way to note that these EU obligations can impact a country's design choices with respect to CFC rules. Klaus, what are the particular pressure points here?
Yeah, just to be short, the only pressure point here is an established jurisdiction of the European Court of Justice called the Cadbury-Schweppes principles, named after this quite famous case. And what it did was mainly interpreting the freedom of establishment principle, which even all companies within the EU are free to choose their way of establishment if it shows some kind of substance. So that is one of the pressure points member states have to obey.
Thanks, Klaus. So then, against this idea that this is all in the form of best practices, the final report discusses 6 building blocks for the design of effective CFC rules, and the building blocks are shown on the slide. the as in the discussion draft, the final report provides recommendations with respect to the building blocks, except with respect to the definition of CFC income, for which it sets out a non-exhaustive list of approaches that can be used by countries. The inclusion of options rather than a recommendation in this area, which is a pretty central question, is a further indication of the competing policy considerations that are at issue here. The discussion in the final report starts from the basic point that a CFC regime should include an income definition that ensures that income that raises BEPS concerns to that particular country is covered by the regime and is taxable to the shareholder or shareholders in the parent jurisdiction. Beyond that, the OECD stresses flexibility for countries to use a definition that's consistent with their domestic policy frameworks. The report further notes that the choice among alternative approaches likely will depend on the degree of risk of base erosion and profit shifting activity that's faced by the country. The approaches that are laid out in the report and set forth on the slide are described as a non-exhaustive list of approaches that could be used. They could be used on their own or combined. One point that the report calls out in particular echoes some of the work in the transfer pricing area, and it indicates that the view that whatever approach is used, the funding return that's earned by a low function entity, a so-called cash box, to use the OECD phrasing, should be captured by CFC rules, at least to the extent of income that's considered to have been shifted from the parent country. So again, in that area, looking at the perspectives of different countries in their overall policies. The report also notes that countries could choose to apply a full inclusion system that targets all income of a CFC, regardless of its character. So a pretty extreme version of CFC rules. Sean, the UK relatively recently has made significant changes to its CFC rules. What's the UK likely to do with respect to this recommendation?
Well, probably not very much, Barbara. I mean, because of the recent changes, I think the UK Treasury believes that the legislation is in line with its philosophy of a territorial tax regime, and the UK regime looks pretty much at only profits that are diverted from the UK and looking to tax those. But I think it probably is acknowledged that if the UK were to implement BEPS Action 2 thoroughly, then it may well make some minor amendments to the UK CFC rules.
All right, and Helmar, quickly, countries that are likely to take action with respect to the CFC report?
I would think, probably a few. Most European countries already have a CFC regime. At least, Western European countries typically have already a CFC regime or something similar. So probably I wouldn't expect too much movement there. Like Ireland Mountain is that they have no intention to introduce CFC rules because they have a system that already works efficiently for them. But Spain and Poland are apparently considering amendments to their regimes. Then outside the EU, there are a couple of countries looking at it. So Russia, South Africa, India, Taiwan, and I understand also Chile.
All right, thank you, Helmar. And I think with that, we're just about out of time for today. Excuse me. This has been a quick trip around several actions that will bring new anti-abuse rules to tax treaties and domestic legislation. Many of the rules are vague and require and will create increased uncertainty for global businesses. In some areas, the OECD is doing additional work. But the likelihood of increased uncertainty will create controversy and risk of double taxation, and will put increased pressure on the dispute resolution mechanisms, which will be the subject of the 8th webcast in our BEPS series. Keep up to date on developments around the world as countries incorporate these recommendations into their own laws, but with their own particular spin. With that, we're going to wrap up our discussion for today. I'd like to thank the panelists for sharing their insights on this important topic, and I also want to thank you, our audience, for joining us today. The archive of today's program will be posted on the Thought Center webcast homepage in a few days. This is also where you can find information about our series of webcasts on the OECD final reports in the BEPS project, and also view many of our other webcasts. As always, we look forward to you joining us again for future webcasts. I'm Barbara Angus, and we've been bringing you news and insights from EY on the sixth in our series of webcasts on the BEPS final reports and related developments in countries around the world. Thanks very much for listening.